Hi, I'm Jimmy. In this video, we're going to look at 7 of the most popular dividend stocks that are owned right now. We're going to go through each of the dividend stocks. We're going to look at what their dividend yield is. We're going to look at their dividend history, compare that to the profits of the company, see how sustainable the dividend is. We're also going to try to look at the PE ratio for each of these companies compared to their own industry. And if we're curious, I got all of these dividend stocks from a recent list put out by Robinhood for the most popular stocks owned by their account holders. Okay, so let's jump right in. So our first dividend stock is a pharmaceutical company known as Pfizer, ticker symbol PFE. Right now, Pfizer has a dividend yield of about 4.3%, so a fairly decent dividend yield. Now, because we all want to have an idea of how over or undervalued our dividend stocks might be, well, I think it makes sense for us to look at a basic valuation method. So in this case, we're going to use the forward price to earnings multiple. The forward PE ratio simply takes the current price of the stock and divides that by the projected earnings per share or the profit per share of that company. So in Pfizer's case, well, the forward PE comes in at about 11x. Now we need something to compare that to. So if we compare it to the S&P 500, well, right now the S&P 500 has a forward PE multiple of about 27x. So according to that, it looks like Pfizer could be undervalued. But those may not be super comparable. So I found some competitors of Pfizer, other large pharmaceutical companies, and the industry average for the forward PE multiple came in at about 16x. So it seems that Pfizer could be in a decent position, at least from a value perspective. Now, of course, we're going to want to do a deeper dive into the company to see if it is in fact a good buy today and to try to determine what price we could buy it. But either way, at least we have a decent starting position. Now, if we look over at their dividends per share over the past few years, well, we can see that Pfizer has gradually increased their dividend. And this actually makes a lot of sense if we think about how long Pfizer's been around and how stable of a company they've been. And then when we add their earnings per share to this chart, well, we can see that Pfizer has covered their earnings, has covered their dividend payouts leading up to 2019. And given the current environment, we can assume that at least some of their products are going to sell fairly well. So I would expect for Pfizer's dividend to be fairly covered over the next few years. Okay, next up, we're moving to a company that's probably not too shocking to see on a list of the most popular dividend stocks, and that's Apple, ticker symbol AAPL. Apple has a current dividend yield of slightly less than 1%, but given their growth, we might be willing to look at the dividend as sort of a nice bonus to their growth characteristics. And right now, Apple's forward price to earnings multiple is about 27x. So that's about in line with the S&P 500, call that the broader stock market. But when we compare that to some of their industry competitors, well, their industry average comes in at about 25x. So they are trading at a slightly higher multiple than the average. And then when we switch over to a chart of their dividend history, well, we can see that they started paying a dividend back in about 2012. And we saw that when we add earnings per share, well, now we can see that not only have earnings covered their dividends, but earnings are growing at a much faster pace than their dividends. So I expect there to be no trouble for them to continue to grow their dividend for the foreseeable future. So again, this is a solid sign for us dividend investors. Okay, moving right along. Next up, we have another company in the very same industry, or at least the very same sector. And this is one of my personal favorite dividend stocks, and that is Microsoft, ticker symbol MSFT. So Microsoft currently has a dividend yield of about 1%, which is low, but again, they come with some growth, so it could be looked at as just sort of a bonus. Now, their forward price to earnings multiple is about 31x. Again, same industry as Apple, so the industry average is coming in at about 25x. So it seems that Microsoft is trading on the higher end right now, which is actually what has prevented me from buying it on a personal basis. Now, when we look at their dividend history, well, once again, we see gradually increasing dividends, and that's been happening for many years, which is exactly what we're looking for. And then when we add earnings per share, well, once again, like we would expect, Microsoft is more than covering their dividend payments, which is a good sign for the stability of their dividend, and it increases our confidence that they will continue to be able to increase their overall dividend payment. Okay, now we shift over to a company that has increased their dividend for nearly 60 straight years, and that is Coca-Cola, ticker symbol KO. And Coke currently has a dividend yield of about 3%, which is decent, but they have a forward price to earnings multiple of about 23x, which, yes, is better. It is lower than the S&P 500's 27x. But when we compare that to the average food and beverage ETF, well, that ETF has an average forward price to earnings multiple of just 17x. So relative to that ETF, it seems that Coca-Cola at this price could be slightly overvalued. Now, Coke gets a bit more interesting in a second. So when we switch over to their dividend history, well, we can see that Coke has gradually increased their dividend, which again is logical and expected. But now, when we add their earnings per share, well, we can see my personal real issue with this company is that earnings per share hasn't gone anywhere over the past 10 years or so. And the dividend amount is gradually catching up to the profit level. So Coke is going, I think if we're going to consider investing in Coke, let's pretend we don't own Coke and we're going to consider investing in it. Well, I think it makes a lot of sense for us to do a deeper dive on that company and to truly understand, does this company have the potential does management have a plan to increase where profits are? Can they shift this from moving flat to moving higher? Now, I also should point out that I completely understand why this would be on a list of the most popular dividend stocks, because people like Warren Buffett, who have owned this company for a long, long time, have always touted the reliability of Coke. And I believe very much that is very true. So I'm not suggesting that if we own it, we should sell it here, because a lot of that depends on where we bought it, how well we're doing in it, what we're doing with the dividends. There's a lot of reasons to own this company. I'm just suggesting if we're looking at it right now, I'd want to know the plan. Company might have a great plan. If you know what the company's plan is, please put it in the comments below. Okay, now let's shift over to a bank that I was actually surprised to see on this list, and that is Bank of America, ticker symbol BAC. Bank of America has a dividend yield of about 2%, and they have a forward price to earnings multiple of about 15 times profit. But if we compare that to the Spider Bank ETF, which has about 90 different banks in it, well, their average forward PE multiple is about 13x. So that's slightly less than where Bank of America is today, which implies Bank of America could be slightly overvalued. By the way, if you're ever looking for a good way to compare companies to their industry, I like searching for ETFs. There's so many ETFs out there now. You could search for an ETF that represents the industry if it's very specific, like the bank industry ETF, or you can go something more broad like a sector ETF. But that could be a good point. A lot of those ETF companies publish fact sheets, or maybe they have data on their website that give you good data points to compare the company to. But either way, when we look at the company's dividend history, well, we can see that dividends have gradually increased after they had their dividends back in this time period here, where it was about 4 cents a year coming out of the financial crisis. And then when we add their profits per share to this mix, well, we can see that profits have been doing a very good job of covering their dividends, which implies that in Bank of America's dividend situation, I would look at this and say their dividend seems fairly safe over the next few years, barring anything crazy happening, of course. Okay, now we shift over to a popular specialty coffee company in Starbucks, ticker symbol SBUX. So Starbucks currently has a dividend yield of about 1.7%. They have a forward PE multiple of about 38x. So this is the highest one on our list. Again, the S&P 500 is currently at about 27x. And then if we compare them to the consumer discretionary industry, well, their average PE multiple in that industry is about 31x. So Starbucks looks to be quite expensive compared to the market, compared to their own industry, or actually that's their sector. But either way, it makes some sense given that in early 2020, Starbucks crashed, logically, but since then, the stock has nearly doubled. So I'm not too surprised to see how overvalued it seems right now. Now, interestingly, when we look at their dividend history, well, we can see that up until 2020, their dividend was growing nicely, and then they pulled it back. And then when we add profits per share to this, well, we can see that the dividends were climbing somewhere in line with what profits were doing. And then in 2020, well, the company, Starbucks, dropped their dividend, I'm guessing due to the fact that revenue was dropping as well, and so was profit. And I actually think that I actually look at this as a positive sign. I think sometimes companies can get too stuck in their need to increase their dividend no matter what. If a company faces problems, I think in the case of Starbucks, pausing the increasing of the dividends or even decreasing them could make sense, versus imagine the company didn't have enough cash and they had to go out to take on debt to continue to increase their dividends. Well, to me, that's not very logical when the problem that you're facing is a short-term problem, which hopefully the coronavirus is. Okay, Now we're moving on to our highest dividend yielding stock on this list, and that is AT&T, ticker symbol T. AT&T's dividend yield is about 7%. Their forward PE multiple is just 10x. And if we were to compare that to the communication services sector ETF, well, that ETF has an average forward PE multiple of about 23x. So AT&T is surprisingly or impressively low. Now, when we switch over to their dividend history, well, we can see that AT&T are one of those dividend stocks that gradually increase their dividends every year. And I'm not sure if that's really great in this situation, especially when we add their earnings per share. And we can see that profits are kind of all over the place, which makes me think that there is some fundamental issue with the stability of their business, or at least of their profit, which could at least partially explain why they have such a low PE multiple relative to their broader sector. Simply put, maybe there's just more risk with AT&T, so people aren't willing to pay a premium for it. Now, with that being said, I do think it's crucial for us to completely understand exactly how dividends work and some of the strategies that many investors use around dividend investing. Now, I recently did a video going through that exact topic. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I have a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.